Tim, let me start with you. Is there any chance at all that we may get a rate increase today? Because this is the first meeting in which it's theoretically possible, given the guidance that we've gotten from the Fed in the past.
Yeah, I'd say the odds, Scarlet, are 50-50. And I say that because 3 months ago, Janet Yellen was hinting that June might be the time that they raise rates. Well, it's June, right? So then I start to look at the data that Janet Yellen and her team are looking at, and they're all green, right? Green lights, green to go. The only blip is, of course, the GDP number was a little negative, but they anticipated that was going to happen. So if I look at the labor market, which is what they say is their prime interest right now, there are some topics there that are just white-hot indicators. So I'd say the odds are 50-50. I wouldn't be surprised if they held steady, but I honestly wouldn't be surprised if they raised rates today.
Wow, Tim Kane just made it really exciting because it seemed like everyone in the markets was pricing in, no, it's not going to happen until at the earliest September. Lisa?
Well, yeah, Tim, you're an outlier. I'm impressed. The market not only is saying that they don't think that the Fed is going to hike in June, there's a greater question at this point of whether they're even going to hike this year at all. And if you look at Fed fund futures, I mean, frankly, they're actually coming down today. Or in other words, the chance of interest rates being higher than 30 basis points or 0.03 percentage point is getting, smaller and smaller. So actually, people are pushing back their expectations for the Fed. If there is one hike, there's actually a lot of questions about whether there could even be another hike this year. And certainly traders do not seem to be pricing in a rate hike today.
And Tim, I have to ask, because you are definite, it seems that, I think Scarlet alluded to it, it seems as if you are on an island unto yourself. I got to understand your strategy for thinking why something might happen today where everyone else says September, October.
Well, just remember, guys, I'm an economist, so I don't have real money at play here. I just deal with theory. But the fact is, it'd be really smart policy to price it, to put in a rate hike now and to see how it does, right? You don't want to suddenly get on a fast on-ramp, and I think the Fed policymakers know that. And I would turn your attention to one indicator. So Janet Yellen has said they care a lot about the labor market. They're looking at how it's strengthening. The unemployment rate's at 5.5%. I mean, that's really a sweet spot. It'll go lower, but that's a sweet spot right now. But it's the jobless claims number that is off the charts. In 4 decades, it basically hasn't been this low. Only once, and that was right before the dot-com bubble burst. Those were sweet times. So the labor market's tighter than people realize.
Well, but Tim, to your point, I mean, you're not the only person who said this, where if the Fed really were looking at the data, they would hike today. The problem is, what is the data they're looking at? I mean, have they moved beyond looking at just jobless data? Are they really more concerned about inflation at this point?
Yeah, inflation numbers look flat, frankly. But wage inflation can come, at a surprising pace. And the other thing we're dealing with is a lot of uncertainty, right? This is a new Fed chair. We don't know exactly what her language is. We don't know. I mean, Ben Bernanke never really raised rates, so it's been a while since we've had to deal with this, and I don't think anybody can really look at the tea leaves and know what they're seeing, other than I listened to, 1, what she said, which was they may raise rates in June, and 2, what they care about, which is labor markets. I study labor markets. They look a lot tighter than people realize. That's, end of story. Those are the 2 points I think we have to go on.
Well, Tim, sit tight for a moment here, because leading up to today, we took a survey from some of the biggest names in finance about what they expect the Fed and Janet Yellen to do. Take a listen to what they all said.
Well, let's get the obvious question out of the way. Policy change today or not?
No way.
Highly unlikely.
So then what is going to change?
Janet Yellen's statement is going to be the most interesting. The issue is going to be how much detail she lays out for the fall. She's been talking about a rate increase in the fall. Is she going to get more specific?
What we're trying to figure out is whether it will come in September or more towards December.
I personally think it's going to be September.
You've heard me say over and over again, the most likely outcome is going to be a September hike.
But I'm not quite as convinced as the market pricing in 100%. Well, I would say, let's say 70%, because if Greece were to blow up, if Eurodollar goes to basically parity by September, if China were to devalue, I don't see the Fed basically hiking rate September. So I think it's highly conditional.
If the Fed were truly data dependent, as they say they are, they would go today. We're seeing some creep up in wages. You have 280,000 jobs coming on every month. And so the Fed should go today if if they are truly data dependent.
The key is not just data dependency here, because the Fed is very sensitive to the ripples that they are sending throughout the world.
They are trying to strike that balance between, on the one hand, not disrupting the economic recovery because it's fragile, but on the other hand, not encouraging excessive risk-taking. And that's why they're going to embark on this unusual tightening. I call it the loosest tightening, to try and balance these two things.
So clearly, it's a very delicate dance that the FOMC and Chair Yellen needs to toe here. Tim, I wonder, as we get closer to liftoff, even with this 50-50 odds for today, will the language become more or less explicit?
Right. So if they don't raise rates, I can't imagine they're not giving clear indications that they will be raising rates. They won't want to broadcast exactly the date, but it will make that September thing look more like a sure bet. So the language will matter. But again, there's so much uncertainty about how this Fed chair wants to conduct policy. I'm arguing they might want to raise rates now and not in September, right? So to put it in, and part of that would be to strengthen the foreign economies, because the U.S. strengthens our dollar. It should help the rest of the world, and that's got to be on their minds as well.
And Lisa, I would imagine that the global markets, they're paying close attention to this too, because they want to see what that is and the implications for the dollar.
Right, although, Tim, it's interesting that you say that, because from what I hear, it's sort of the opposite, that if the Fed hikes, particularly emerging markets, I mean, maybe not in the developed nations, but certainly in emerging markets that are struggling and have issued a lot of debt in the past couple of years, trillions of dollar-denominated debt that they're going to have to repay, it could potentially pose a problem if rates do increase here. So it sort of depends on how quickly, and it depends on, really the strength of the rest of the world and whether they're going to keep up with us.
Fair point. They're double-edged swords to all this. I guess I'm thinking more about export market strength of the dollar in terms of bringing in more imports to the U.S. I worry a little bit, and I think people should worry a little bit about interest rates this low cause bubbles, right? They've caused bubbles in these last two cycles, .com and housing. We don't know where the next bubble is, but I worry that rates have been too low for too long, and it would be a really nice signal to see we're going to get rates in line with the strength of the economy right now if we're data-driven.
So your view then is that it's a bigger risk for the Federal Reserve to wait rather than to do something right away?
Yeah, I don't think you want to wait for the inflation to come up before you start to get back to normal. Right, because then it can become like a brush fire. If inflation starts to take off, it can be very hard to tamp down again without a lot of pain.
All right, Lisa, let's let you get the last word in here as we approach 2 o'clock here in the East.
Well, I think that if they do come out and give signals, any strong signals that September is the time, I think it will actually be interpreted as hawkish. That's what I'm hearing from people in the market, that actually it could provoke a little bit more of a dip in bond values.
And the last statement, the April statement, was fairly dovish, all things considered. Right. But we also had all the weak first quarter economic data to go along with that, leading into that report.
So now we have stronger economic data. You do have the Greece cannon out there that could potentially cause some kind of disruption. So that's sort of what people are looking at. Also, one thing to be aware of is how much will the Fed really raise issues of geopolitical concerns, and particularly with Europe.
Okay.